Well, good day, everyone. Welcome to our webcast on trading a smaller account. This is Connie Hill, Senior Manager and Education Coach. I'm sitting in for Barb Armstrong today. She is over at the Chicago Advanced Options Workshop. And so she will miss you, I'm sure, but I'm happy to be here today. Usually I'm in the chat, but today I'll be presenting. We do have Scott Thompson in the chat, so you know Scott. And so if you want to have questions, he's going to help me field some of those questions that I can't quite get to. All right. So as you have them, go ahead. And then those of you that have questions that are listening to the recording, when you have a question, put it down in the YouTube comments, because I go back and look at those throughout the day. Make sure you can get your question answered quickly as well. Now, I hope you're following us as coaches on X. It's just free to do. Create an account. You can follow us. And we post different things throughout, educational and what we see in the market throughout the day. So you can get in on some of those little nuggets. So don't miss out on that opportunity. Let's go through our disclosures, and then I'll lay our agenda, what we're going to focus on here today. We will be doing option strategies, and they have a high level of risk and are not suitable for all investors. We will be using the Paper Money software application. It's for educational purposes only. Past performance of any security or strategy does not guarantee future results or success. And past performance of any security or strategy does not guarantee future success. All right. Wanted to advertise some upcoming workshops, all right? A couple of them have closed, so we've taken those down, but we've got Detroit, Denver, and Anaheim now that are available to you. Anaheim will be an advanced option strategy. So those of you that are feeling really comfortable with your different option strategies, putting different verticals together, that type of thing, you might really enjoy being able to go to the advanced workshop in Anaheim. And I know there are some of you that are planning on going there. And I just wanted to do a quick hello and shout out to some of you whose names I recognize here. We've got Susie Q coming in bright and early, BJ, Art, Kevin, Jack. There are just several of you. Happy to have you here. Now, one thing I want you to think about here as we go into our agenda is, do you have a really solid watch list that you can use to go back to identify the stocks you want to use for this class, or trading your smaller account? If the answer is no, I'm going to give you some tips on that today and give you a reference. But that is going to be one of the things we're going to focus on as we're going to create some example trades for our class today that might be appropriate to do in a smaller account. And of course, we always like to show you some management type situations, and we'll do that as well towards the end of our class. Now, I think these are the rules that Barb uses in this class. If any of these rules have changed, go ahead, put it in the chat, let us know, okay? Typically, we're thinking, hey, what is a smaller account? Some people's smaller account might be $5,000. Your smaller account might be 20 or even higher, and you think it's a small account. So we just focus on a $20,000 account here. We will not spend more than $5,000 in any position, and we don't want to risk more than $400 to $500 per trade. Okay, we're going to manage that risk. If we had several trades go against us in a row, we just want it to hit us a little bit. We would not want it to be doing real damage to our accounts. So time frame we focus on is intermediate to shorter term time frames. And in this class, Barb will entertain both bullish and bearish strategies. So here are the bullish strategies that could be considered and that she has used in this class. Market not looking so bullish right now. We'll take a look at that. But the bearish strategies that she will focus on might be long puts, long put verticals, and short call verticals. We're going to do a couple of those strategies here today. At times, it might be appropriate to use iron condors or calendars that might be a little bit more neutral and less directional in their nature. Okay, so those would be the ones that we would be focusing on here today. Now, let's head out to Thinkorswim. Let's head out to my account. Make sure I bring the right one up here. And this is it. And we're just going to start with the SPX here. All right. You guys know what's been going on with the SPX. Got several moving averages on the screen here. Blue is a 10-day moving average. Red is 30. Gray is 100. And this green is the 200-day moving average. And if you've been paying attention to what's going on in the market, you know that we've had a lot of time below that 200-day moving average. Sometimes when we see markets or stocks pull back to that level, we might anticipate that value investors are thinking, oh, some stocks are pretty cheap right now. Maybe we might be interested in them. And so sometimes we'll see a bounce at the 200-day, either on individual stocks or on markets. Not really seeing that right now with the SPX and the NDX. All right, so today it looks like we are still down, maybe about 0.7% or so. And so that's a decent, healthy amount. You can see I drew a flag pattern in here. One thing we were looking for in one of my other classes was for the SPX to break out of the flag pattern, which it did, but then it hasn't continued to drop. And so I'm going to say, that pattern is a little bit broken here. Some people might change it so it's a different flag. I mean, maybe the connect points are a little bit different. Somebody might come out here and maybe rework the flag, so maybe it's on a little bit of an angle, maybe something like that. We just don't want it to go 3/4 of the way up the flagpole as far as a retracement. So some might say, let's adjust the flag and let's look for a breakout out of what we would call that bearish flag. Okay. NDX, take a quick look there. It's not going to look a whole lot different than the SPX in the sense that, yep, it's down below its 200-day moving average. And we've had kind of like little bursts of wanting to accelerate, move to the upside. They just haven't lasted very long. NASDAQ's down about 0.7% here today as well. Even though the candle, you're seeing it green, technically it is down a little bit so far today. Now, something else we pay great attention to is, right, this is kind of the fear factor. It gives us the put-call ratio, which if there's a lot of put buying, that means people are a little bit more nervous about the market, maybe a little bit more defensive or bearish about the market. And so we love to see that ratio charted out. And when we've been in higher ranges recently, that's been up about 27, 28 or so. We have been fairly low here. This is just a 3-month chart here, but it's been down in the 13s and even in the 12s in the past, say, year. Rolling year, not necessarily just year to date. And so those represent lower levels. So we're kind of in a range now. It's about what, 20-ish, okay, where it's not super low, but it's not super high either. So I'm going to say the volatility and the nervousness in the market, I'm going to say still is looking a little nervous, but not extreme. Okay, it's not at the extreme points that we have seen before. Now, one of the things that we talked about yesterday in one of my classes, which was short verticals, is we talked about having a watch list. Okay, and the watch list that we talked about could be used for pretty much short verticals. However, I'm going to tell you, quite honestly, it doesn't have to be used just for short verticals. I think it could be a watch list that would be really helpful to you to have for lots of option strategies, both bullish, both bearish. So I'm going to post out here for you a link, which is the class that we had yesterday, where we spent a good deal of time in the first part of the class talking about how to create this watch list, because I think it can be entirely appropriate for those of you that are in this class as well. So let me copy it to the chat, and I'm also going to share with you if you wanted to see the whole webcast, where you might be able to do that. Hopefully you guys are subscribers to the Trader Talks channel on YouTube, because it makes it so easy for you to identify our information. You can click that little icon if you haven't already. That's the blue YouTube looking icon to subscribe to it. And when you do, what this allows you to do is you would be able to go to our Trader Talks channel. You see what might be coming up. I've already got it switched over to playlists. And to find that playlist for our short verticals class, you might go down 7 rows or so, come over here to the 4th one, and that will be the playlist for that particular class. And right next door is trading a smaller account. Hopefully you're familiar with that, to be able to go back and view some of Barb's previous classes, very specific to, trading a smaller account, having smaller position sizes, okay? So by being a subscriber, it really helps you out in that area. Now, we're going to do just a brief look at something we did yesterday. I'm not going to build the whole scan for you step by step, but I'll show you what we did. In here, we said we are going to intersect and look for stocks that are on the NASDAQ 100. Typically, they're larger cap stocks. There's a lot of trading activity. And as an option trader, especially, you're looking to have low spreads. You're looking to be as efficient as you possibly can. So what we did here, we said, all right, minimum stock price would be 40. I told you this could be used for both bullish and bearish. All right. So we had a minimum price of 40. And then I came in, used the study filter, brought up average volume. 50 days is just fine, but you're going to notice here, what we have is 2,500,000 as the average volume we want to see. Now your threshold, you might be a little bit lower, you might be a little bit higher, but we would like this to bring back stocks or for us on the NASDAQ that meet those requirements. So not all 100 are going to qualify. If I hit scan, this should be pretty similar to what it was last night. So yeah, it looks like it'll bring us up 59. So we'll change this. We'll say, all right, let's get the whole enchilada. Let's go 200 so that we can see the entire list. Now, you might decide to save these over to a watch list if you want. You don't even need to do much more filtering than that because most of them, you might find some exception, most of them are going to come back fairly liquid. What I also did in that class, and I showed you how to do it there, was to do the same type of thing, but using the S&P 100. If I come down to the S&P 100 here, we did the same thing. We said got to be at least $40, and it's got to be 2.5 million in volume, and showed you how to add that list to the initial list that we created off the NASDAQ 100, okay? Yeah, and net result here is that we have a watch list that can be really useful. And so it has on it probably over 100 stocks at this point. You can see today, some of them are bullish, some of them are bearish because I have it sorted by the percent move today. Now, the examples that we're going to look at today came from that watch list that we curated yesterday. Okay. Just a quick, Reason says, is there any reason you didn't intersect with the weeklies on here? You certainly could add that if you wanted. Okay. I wanted to do very specifically, we could come over here and we could say the S&P, say 100 here, and to intersect it with what Wiley's suggesting here, basically showing the weeklies that typically are a little bit more weekly or a little bit more liquid. And so, yeah, you absolutely could do that. Let's see where these are. I just pointed out here, right at the bottom of this public watch list is the weeklies. For the fun of it, let's see what it might change. Okay. Let's take this to the NASDAQ 100. So we're seeing how many of those filtered out. So on our NASDAQ 100, it's going to be right here, the bottom of this public watch list. And if it is intersected with weeklies, initially before we intersected it or didn't intersect it, we had 59. Let's see what that does to it. Okay, so it filters out about 10 of those stocks. So it's absolutely something that you could do, trying to filter for liquidity. I like that extra step there. All right. Next up, let's take a look at some of the charts. And what you can do is if you build a similar type watch list, and I'm hoping you have one for this class. If you don't yet, you could use this process that we went through that you could use for a watch list for this class. And so we're going to take a look at a couple of stocks that come up on here. First one we are going to deal with is, let's look at, see if Starbucks still looks like possibly a bearish candidate. And I would say, yeah, it definitely does look like it could be a bearish candidate. The moving averages, our intermediates down, our 10-day is down. And notice it's been below that blue 10-day for quite a longer period of time, even though they had some good earnings. They ran for a bit. The market is pulling back on a lot of stocks, okay? We can see here the last pullback and then a little bit of a run up. And what's it doing now? It looks like it could be doing one of two things. It could be bouncing down off the 10-day moving average. It could also be bouncing down off this 99 area of resistance. If I go back a little ways, we can see that it was kind of a resistance area in the past. And this might be, in the neighborhood, maybe 99 to 100 as it came up here. And so it looks like, yeah, it's using that as resistance again. On a bearish entry, we love to see it being a close below the low of the high day. In fact, some things we might look for as far as signals, these are going to be the ones here in the yellow, and these are going to be signals some traders like to use for bearish entries. Okay, so a break of support, which in this case, it didn't break off that support, but what it is doing, it's bouncing down off resistance and a moving average, that 10-day. And those of you that really like the signal looking for a close below the low of the high day, looks like it may qualify for that. Now, we don't have a close yet. It's still pretty early in the day. It could totally change, but some traders might take a move. If it moves lower than the low on this high day, which happened to be yesterday, they might use that as an entry. So we're going to kind of go off of those bounces off resistance as well as a move below the low of the high day candle, right? The high day, as it runs kind of back up, you might have noticed a flag pattern here. So that could be an additional one that maybe through here is the consolidating flag, right? And the flag pull, some people might start it here, go all the way down. That's a pretty decent flag pull that can give you a target to look for. Now, we're going to do a spread trade on this. Why would we do a spread trade? Spread trades can be very helpful. We'll come over here to the trade tab on Starbucks. They can be very helpful because of a couple of things. One, you can participate in moves of higher price stocks. When you have a smaller account, some of these premiums might be a little bit higher in just buying it alone. Say you wanted to get, buy something with a 70 delta, might cost $5.30, translating to $530 for one contract. You do a spread, you can do a couple things. You can use less capital to lay out. It allows you to maybe target and create some higher probability trades. And so that can be really useful as well. And Barb has done a lot of focusing on verticals. You guys know as you attend her class weekly, yeah, that is kind of what a majority of your trades happen to be. So let's go ahead. Let's construct on this one. We're not going to do a short vertical, but we are going to do a long vertical. Okay. And one thing, we're going to use these April options for Starbucks. Let me make sure that I approved that. No, we're not. On this one, we're not. We're going to use the monthlies. Okay. You can see here, this is my open interest column. And you can see, yeah, there's some liquidity, but man, would love to see a lot more contracts out here. The 97 on the put side here does have a lot of open interest, but some of these are really sparse. So on this one, we're going to just drop down to the Aprils. When you're doing verticals, many traders like to use between 20 to 40 days worth of time. Sometimes you have to go out to about 50 days, depending on what you're working with here. Sometimes these weeklies will offer you some additional opportunities that you could go into. Right now on Starbucks, the weeklies aren't looking the best. So we're going to go with the April 17 monthlies. Lots of open interest out here. We can be happy campers. No, we're just, our contracts are going to just be a small number in the ones we're actually going to use. Now, for a long vertical, many times we want to start at the money strike price. You don't have to. You can start a little bit in the money, and really 97's kind of almost not perfectly between, but it's a little bit closer to the 95 strike. But we would require the stock to move quite a bit if we sold this 95 strike price. So what we're going to, or I take that back, we're going to buy our first leg. We're doing a long put. I'm going to start it at 100. And let's just kind of see where it pans out. Am I looking before the market started? 100 seemed to work out pretty good. right mouse click, buy vertical. 100's our leg we're going to start with, and you can see the 95 is the next one in sequence, and that seems to be appropriate. Now, right now, our net debit on this would be 247, and so we can do 2 contracts here. We don't want to risk more than $500 a trade. What would our max loss be? Well, it would be 247 times 247 times the number of contracts, which in this case, we would do 2 contracts. That would keep us under our 500. We would be risking, I'm just going to lock this. Okay, we'll go with 248. We'll lock it in place. We're risking 248 to make what? 252, because that's the strike difference minus our net debit. So we're risking in the neighborhood of $1 to make $1. Does the stock need to move? Yeah, it still needs to move down some, right? Or we want it to go past whatever this hedge leg is, which in this case is 95. And so we want to see it continue to drop. It's at 97. We want to see it drop another $2.06 and go below that strike price. Now let's look at that on the chart. If I were to map out here where the 95 strike is, right about, well, that's pretty close. Okay, 95 and some cents. The stock it needs to actually do some moving. But if it does, it puts us in a situation where we could get a pretty decent return on it. Okay, in the neighborhood of about 100%, but we might be satisfied for a little less than that. Okay. When trading verticals, I think it can be helpful for traders to say, well, let's not hold our breath trying to get every little penny out of it. Instead, let's try to get a chunk of it. Okay, think of a bone, maybe some ribs. I like ribs. Do you like ribs? Think of some rib bones, okay? And you might not nibble every single little thing off the beef bone or the pork bone, whatever it is you're eating, okay? But man, if you could get most of it, not worry about maybe a little flex here and there, you might be happy with that. Take that same approach with your option strategies. Let's go for a chunk of it and be happy and satisfied to move on, lock in some gains and carry on. Okay, so that's what we're going to do with this trade. I told you we could do 2 contracts. Let's change this to a first trigger sequential because we'll go ahead and put in a possible exit order here. So we'll create an opposite order. And let's go ahead and say, if we get 252, that would be our max theoretical gain. Here, let's go to our calculator for a minute. And what if we could get 75% of that? That would be nice, right? Leave a few flecks of meat on the bone, maybe some gristle, whatever, right? But capture the majority. Sorry for those of you that are vegan. Maybe this is not a good analogy for you veganers. Okay. Actually, I think you're called vegans. All right. So let's go 2.52. So you have 2 times 0.75. That would give us 75% of it. That would say, okay, let's try to capture 189. All right, we're going to add that 189 to what our net debit is already because we want it to move that particular value, and then we're going to say get us out of the trade, lock in the gain. So 189 plus our 248 says, all right, let's go buy it back at 437. We don't have to get every last little penny out of it, but we're going to get a chunk. Buy it when it gets to 437. We don't know if or when that might happen, okay? But we would want it to execute the trade for us. I'm going to show you an example in just a minute of a trade that did just exactly that for us in our short verticals class. It went ahead and hit our exit order. We didn't have to sit there and try to catch it. That can be an advantage to putting in an exit order. Now, there might be some of you that might say, well, I want to also put in an order if it goes against me, and you're certainly welcome to do that. In our example today, we're not going to do that. But if you did, you could do a first triggers OCO, which stands for one cancels other. One could be your exit price if it works out in your favor. One could be an exit price if it's going against you. Okay, so you certainly could do that as well. It's kind of a hedged position where we have it right now, so we're going to leave it there. we're going to go ahead. We're going to hit confirm and send. We're going to send it on its way. And looks like we got filled on that about 244. So it's even a little less expensive then, which is just kind of a nice bonus. Just looking at the questions here, looks like mostly Scott is helping you out for certain, looking to see if I need to cover anything. Okay, yeah, we could use, Kevin, we could use like cutting off the crust of your sandwich, right? Peanut butter sandwich, you're cutting off the crust, but you're keeping the meaty part or the big base part of the sandwich. Absolutely, I like that. We could go for a sandwich in that case. All right, next up, let's collapse this. Let's go back to our watch list. Another stock that we had from our scan yesterday is Qualcomm. Where did he go, Qualcomm? Oh, there it is. There is our Qualcomm. Let's go look at the charts on this. And let's kind of back out a little bit. Has it been downward trending? Yes. Have some of the semiconductor and technology stocks, they really taken it in the chops? They have. And what's interesting here is a lot of stocks seem to be in a little bit of a trading range, right? They're just kind of neutral. Could they turn out to be rebounding stocks? They might, right? This could be maybe a little pullback, a base being formed, maybe pulling back here again or running back up. If you were thinking maybe this is a little bit more bullish than bearish, then somebody could put on a contingent order that said, okay, if it goes that high, great, let's trade it to the bullish side. Now, looking at it here, it could also work for kind of a neutral strategy where we might do a short call vertical and say, hey, let's see if you'll just stay below a certain price. We don't necessarily have to see it drop below 150, okay? Doesn't need to break that area. You can sit here and dink around in the middle here, and using a short call vertical, there's potential there that could be a decent trade to work out. So let's go construct that, put that together. As we go to the trade tab, we're going to go to Qualcomm, and we're again going to use these April 17 options. You can look in the weeklies if you want. They weren't as liquid as what I wanted to see. And when that's the case, I just go out to the monthlies, and 27 days is perfect in that basket or that range that we typically look for. All right, so on this, we're going to use calls. We're going to be bearish. And so many times we want to sell a call out of the money. That means we want to sell at a 20-something delta or a 30-something delta, or maybe at a 40-something delta. Now, let's see if this is still looking good for what we're doing. The stock has bounced a little bit. And so the delta here is actually a little higher than when I was spying it earlier, okay? But let's see what that might look like. We were looking to do a 160, 165 short vertical. Our maximum gain on this is 175, and that's actually really healthy. That's quite a bit more healthy than what I was looking at, but that's okay. We'll still go ahead with this example. What does the stock need to do? Well, we want, in our ideal world for this trade to work out, we want it to go past 160. We want it to drop. Well, is it already there? Let's see. Let's make sure I'm focusing on the right strike price here. Yeah, we're selling our 160. The 165 is going to be our hedge, creates this little credit here. Now, let's just look. Okay, where is 160? Is it already below it? Yeah, it is. 160 turns out to be kind of where this resistance area is. It's nice if we can sell kind of at resistance. It's even nicer if we can sell a little beyond it, okay? But if we were to sell 165 up here, it's not going to bring us enough premium. I already tinkered with that. I said, it's not going to be good enough for us, okay? So we're going to go with 160. That gives the stock some leeway. It's already at 156. It could recover, what, $3.80-ish, right? It could work its way up here, stay below resistance, maybe even go above it for a few days and pull back down, okay? Could still be a completely legitimate trade for this particular stock. So let's come back here. Let's do some math. We're going to pull out our calculator. We'll collapse that watch list. Well, actually, I'll still let you see part of the watch list here, okay? Maybe I'll scroll down so you can get an idea of some of the other stocks that are on it. Again, we're going to use it in our class for both bullish and bearish positions. Okay. If our max theoretical gain here is $1.76, it keeps getting a little nicer, doesn't it? We are going to say, well, our theoretical max loss is going to be $5, the difference in the spread, minus whatever our credit is. Ooh, it even just ticked up a little bit more here. All right. And so 5 minus 178 is going to be what for us? Should be $3.22. We'll just make sure that's the case. $5 minus $1.78, $3.22. Good thing I used a calculator there. Yeah. Let's do that. Just for this count, make sure that is 5 minus, oh, now it's 175. I think I'll lock it in place there. All right, let's lock that in place. So 325 is our max theoretical loss. In our account, we're only willing to risk $400 to $500 a trade, so we will do just one contract. Okay, everybody good with that? And we're going to take the same approach. We get a chunk of this. We're going to be happy campers. We're going to let Thinkorswim do the execution of our order. We can be out walking the dog. We can be out to breakfast. We can be doing whatever. And Thinkorswim, we've got that order out there. So if it gets to that point, it can go ahead and execute it for us. So we'll do a first trigger sequential again. We'll create an opposite order. And when, let's see, I think that went to the Analyze tab. That's not what I wanted. Let's do it again. Create an opposite order. I think I clicked just a little too low. We're going to say, hey, go buy this spread back. Put this exit order in when we get a chunk. Now, a chunk on this one, let's go for 70%. Okay? 70% on this credit spread. So $1.75 times, we're going to go for 70%, then only 30% is left. We'll multiply that by 0.3. We're going to say, go buy it back for us at 50, basically 52 cents. We'll cut off that extra 5 at the end. We'll go to 52. We'll say buy it back at that. We'll be happy, right? Our net would be $1.75 minus the 52. So we're still bringing in a pretty healthy return there. It doesn't have to be, we don't have to be greedy. We don't have to go for all of it. Always want to make this good till canceled. We don't want to have to go set that up every day, right? Just put a good till canceled so it will continue. Let's go ahead. We're going to submit this order. We're going to send it on. Good. We got filled on it. Ooh, we got $1.81 out of it, not even $1.75. That thing's moving around. That means probably the chart might be moving up a little bit because those calls became more valuable. Okay. And again, it can go sideways. It can come down. That would be more ideal, have it come down. But as long as we can have it expiring, say in that last week below the 160 and get us out of the trade early, that's what we're looking for here. All right. Let's look at one more here. Again, this came from my watch list. And this one is Nike. Where did Nike go? Maybe Nike's popping up a little. Maybe he's up higher on the list. There's Nike. Nike's down about 5%. Now they had earnings. Apparently we're not buying enough Nike tennis shoes from them, or basketball shoes, whatever you play. Disappointed a little bit, which is kind of interesting because they had run up. They had formed a higher high and they had formed a higher low, right? But then what did it do? It kind of broke down, forming lower lows, lower highs. Definitely those 30 and 10 days are pointing downward, letting us know, okay, the trend that's going on right now is a little bit more bearish. Now, on Nike, it's getting a little bit of a bounce. Okay, so don't be surprised if it runs up a little bit, and it can, all right? But ideally, would want it, if we do a short call vertical on it, we'd want it to just kind of stay down in that range. And some stocks that have been hurt on their earnings, that's kind of what they've been doing. We saw that in the previous two examples that we looked at. Now on Nike, we're actually going to use, let's see here. let's just take a peek here. I think we're going to use the April 11th. Let's make sure we've got enough liquidity here. We're looking to do here something with single strike prices. Oh, that's nice. It's not spread out by 5. It's not spread out by 2.5. It's spread out many times in the weeklies with dollar increments. That makes it a little easier to kind of get your perfect strike price that you're looking for. So we're going to look on here. Initially, I was thinking to do the 70 and the 71. Let's see what that looks like right now. The probability, if we sell this 70, the probability of it expiring out of the money is 65%. You can see my mouse is pointing on this column. It's this probability O is really probability out of the money. Okay, so as you come down here, yeah, it's already at a 66% chance of expiring out of the money. We have a little bit shorter time on this. We have 21 days, not 28, okay, because it's a week shorter. But we're going to go ahead with it here. So we're going to say sell vertical here using our calls. And if you wanted to spread it out more, you could. Because we have the time, we're going to do a quick comparison. I'm going to do a blast all, and we're going to compare if we came down a little bit lower to the 29 delta with a 71 strike price that has a 73% chance of expiring out of the money. And let's kind of see what that might give us. Now I'm going to lock these in. Ooh, that got nice, 27 cents. And what we could do is say, which one of these do we prefer? The 27 cents, it popped up there, which was kind of nice. Wasn't expecting it. Let's keep it a little bit lower. I don't want it to be too high in the sky, okay? Let's look at that. If we were to do a $1 wide strike, our max credit, max that we can earn on the contracts we do is $26. But we can do, so the max loss is going to be about 74 cents. First of all, let's see what kind of a return that gives us. Okay, 0.26 divided by 0.74, our max theoretical loss, a 35% return. And it's starting out at 73%. We might even be able to go further out of the money, but I think we're just going to run with this one. In fact, we'll get rid of this. This gives us a 40-something return. We're not going to be so greedy. We're going to work on the side of probability. And we're going to say, hey, stock, could you please just stay below 71, which, trying to get my mouse right in that area, it's kind of close to that line, but not quite there. Okay, so basically this area of resistance, we're looking for it to stay below there. Now, if we have some buyers come in here, they're thinking it's a value, this may run up a little bit, but we will still look to that 71 line as being our point of resistance. Okay, again, this is another short vertical. And if we can lose 74 bucks a contract, let's go 500, divide that by 74, and we can do 6 contracts here. Okay, so we are going to do that. If everything in the world went wrong, that's our theoretical max loss. All right, let's go ahead. Let's change this to a first trigger sequential. And let's do an opposite order here, create opposite order. And we're going to say, yep, when we get a chunk of it, we're going to go buy it back. Now, your chunk may be different than the chunk examples we're using today. We've used 75%, we've used 70%. Some people they'll say, hey, if I get 50% in a week, I'm a happy camper, okay? Know that number you can practice in your paper money account, kind of see what feels comfortable to you. Some people might also base it on how many days they have left in the trade. And they may say, okay, there's a little bit lower number of days in the trade. Maybe I will be satisfied with a lower percentage. Maybe they go 65%. Okay, we're going to just stick with the 70 on the short verticals. Okay, so we've got 0.26. Divide that by 0.26 times, we're going to go 0.3 again. We've got 70%, only 30% is left. We're going to go buy it back at 7 cents. 0, not 47, just 7 there. And then we're going to make it, again, a good till canceled. All right. Let's go ahead. We're going to put that in. And I'm going to follow up with all of these. I'm going to follow up with the short verticals, I should say, in my trading short verticals class next Thursday. Okay, so these are going to be some more examples that we can follow through with. And I'll go ahead and send them in right there. Now, I wanted to take just a moment, okay, and show you when you put in the exit order, how sometimes that can work out really good for you. Okay, we're going to go to Chart Gilead. And this trade we did in our short verticals class a couple weeks ago. We had seen Gilead breaking out of this flag formation, and we had a nice projected target for it. And nicely enough, it followed it. Okay, it went up it. We put in an exit order to get out at 70% of the max gain. And sure enough, on this day, pretty early in the morning as it ran up, it hit our 70% of our max gain that we're happy campers to be out. Now, let's see what's happened to the stock since then. What if we hadn't had the order in there? What if we hadn't closed out at a majority of the gain and we held on? Well, we would start seeing our profits slide away, slide away, slide away as it pulled back, and they were due to expire today. Okay, so we would not want to be in this situation where it's going to expire in the money. Okay, because then theoretically, and this is likely to happen when the options expire, yeah, we'd be put that stock. Especially if it closes, we've got 110 to 115 here. Yeah, our 110 is right here. For 3 days, it's been down below it. Okay, so I just wanted to show you an example of how that can help you out by putting your order in to begin with. All right, now how many of you are doing some active paper trading out in your paper account? I hope all of you are. Okay, it certainly is something that will help you out a great deal as you're learning these strategies. When you might want to use some of these strategies, do it in your paper account, get comfortable with the buttons, get comfortable putting in exit orders, so that when you kind of flip the switch and start doing some things in your live account, and you don't have to flip the switch and say, I'm only going to do live account now, right? But when you feel comfortable with the strategy, making that transition over to your live account makes it a lot easier because you have confidence in what you're doing because you've been practicing it. Okay, on my golf swing, on my tee off, I'm only going to get further yardage if I go out and practice. Okay, if I just sit and watch the Golf Channel, that's not going to help me all that much, right, to improve my golf swing. All right, let me just check and see if there are any questions that I need to address. I think you guys have been very inquisitive today, and Scott's been able to help you with those questions. A question here from Marbell. Would 6 contracts, would you ever leg out of the trade, and what would that look like? A reason to consider legging out of the trade is if, and we've done this in our short verticals class, the trade were to go against us. Rather than closing the trade down, what we could consider doing is buying back the short leg. Suppose, in this case, we didn't call spreads for bearishness, but suppose we had done a short put vertical and maybe the stock turned bearish and it met our exit criteria, it breaks support significantly, and you're like, oh man, this thing has changed. This leopard has different spots now. This is definitely a bearish trending stock and not a bullish trending stock. And you don't do it because you're a little bit antsy, or maybe it's getting up close to your strike price. But then what you could do, you could consider, say in this scenario, buying back a put option that's short and letting the long leg run. The difficulty in doing that with a short call spread, well, you could do that as well. You could, if this stock started being quite bullish, you could go buy back the short call because that's the main one. That's the one we've sold. And we could just hang on to our long leg. If these bear trades all of a sudden turned bullish on us, we could do that exact same thing. Okay, that might be a scenario when you might consider that. All right. So you practice these trades, okay? Practice them out in your paper money account. I'm going to encourage you to follow us on X. I'm Connie Hill, CS. And if you haven't taken the time to do so yet, register for our Trader Talk so you can find our content really easily. I think that's one of the great things in YouTube is you can subscribe. And I've got a lot of YouTube channels I subscribe to. Man, I can just pick my subscription that I'm looking for the podcast in and go right to it. All right. Now, next up, we will be having advanced charting. Cameron May is going to be leading that discussion. That's going to start at the top of the hour. And then I'll be back on Monday at 4 p.m. Eastern Time for our discussion on ETFs. Have a great day, everyone. Thanks for being here. I'll see you again on Monday. Bye-bye.